Welcome to part two. In this section, just want to begin by noting that there's pretty good evidence that a lot of farmers are looking at a better amount of farm income they've had in several years. And there's some opportunities here to make some wiser decisions about what to do with this extra money that you might have. Not every farmer has this money, not all these program payments. This is the average and the aggregate. There are still deviations of individuals from this. But many farmers are looking at a high income year after several years of tight money. So what are some things a farmer can do? I want to remind you of the new tax tables. These came out in the Tax Reform Act that passed a few years ago, and it hasn't really been an issue. But this year, you might want to know what the new brackets are. 80,000 is to jump up to the next bracket for married filing joint, and then you have the brackets after that. And you also have self-employment taxes. Almost all farmers are paying self-employment taxes. They're 15.3% on that first 133,000 essence. And then it flattens out after that to only 2.9%. So that's on top of these brackets. And so this line here on the horizontal axis is adjusted gross income, your taxable income, if you will. And this is the total tax that you would owe. This would be your ordinary income tax that we looked at in those tax brackets, plus any self-employment taxes. And that's fine as expected. As income goes up, your total tax paid goes up. But I'm going to look at it now in terms of a rate, where you just take the total taxes due divided by the average adjusted gross income and get the percentage that you're paying off here. And really what I want to point out is, yes, it rises quickly, but then it kind of gets flat there for quite a while. This only starts at 20% up to 34% here in this figure. But from $90,000 to $490,000 of adjustable gross income, what are you paying for your rate is 28 to 31%. It even goes down here for quite a while until you hit that next bracket here. Where more income, you actually pay a lower tax. And it really has to do with the bending over. Once you hit that 132,900 at the self-employment tax really falls off. So in a lot of ways, the way I think of it is the tax rate is fairly flat for a big chunk of the region. Once you get above that low levels of income of like 90,000, it flattens out quite a bit. So then you're asking yourself what to do with the extra money. A lot of people focus on avoiding taxes, finding ways to spend that money. But I think you need to be careful about this. And you want to use this as a chance to increase your profits by increasing your productivity in the long run or reducing your cost of production. So quick ideas are, of course, replace capital assets or invest in new assets. We'll talk about some stuff there. And then increasing working capital to improve your financial risk management. And the last one is to pay off some deadweight debt. So this first one is just paying off or buying new assets or replacing them. A lot of farmers have, for tight money in the last few years, have really avoided capital expenditures. It's time to replace some tractors, some combines, and choppers with newer models or brand new ones. The other one is updating things, new parlor, robotic milking, whatever you're buying, more cows, land, whatever you think you're for, whatever you think your operation needs. This is an opportunity for the first time in a while to really take advantage of some of these things you've been putting off. I think the key is to focus in on getting productive assets, not avoiding taxes. Avoiding taxes, yes, you want to manage your taxes, but really this is an opportunity to invest in the future and do something that will make your productivity go up or your costs go down. You want to generate rates of return exceeding your interest rates, the opportunity costs you might have, and reduce your costs for future profitability. Section 179 is a popular way to buy assets and fully depreciate them to greatly reduce your taxes now, and you should take advantage of them. If they make sense. We'll look at some examples here. But you can do machinery, equipment, cattle, grain bins, fence, tile drainage, milking parlor, things like that. Always remember, you cannot use Section 179 for multiple use or for land. Multiple use buildings like a shop or a storage barn that does grain and machinery, things like that. Those are multi-use. I would confirm with your tax accountant to make sure if you're thinking you're going to be able to use it for Section 179, you might not. Just make sure you understand whether what you're thinking about doing does actually give you that tax advantage. And also the rules have changed on the amounts. And so you want to confirm with this. It's probably something you haven't looked at because of not having the cash. This year you do. You might want to refresh yourself with those rules by speaking with your tax accountant. The other thing I'd remind you of is depreciation on machinery and buildings is a hidden cost. You want to make sure you remember it. You want to avoid that 28 to 31% taxation, but you don't want to forget about depreciation. You don't write checks for it, so people tend to forget about it. But it's a real cost. And so there's a ways to estimate that. There's a nice little uh, uh, worksheet, a fact sheet with some Excel spreadsheets to use from Iowa State University Extension on estimating what they call capital recovery factors and then estimating your actual costs of depreciation, opportunity cost. So really what the point is make sure you really need the machinery, that it will improve your productivity or reduce your costs, because you're going to be paying for these depreciation and opportunity costs for many years. So what I've done here is just take the spreadsheet and do a little work, look at 3 different types of equipment, have an opportunity cost or your interest rate. So if you're borrowing at 5%, or that's your normal rate of return in your operation, you generate 5% return on your investments on your assets. Well, that's your opportunity cost if you take that capital and put it into a piece of equipment. There's the capital recovery factors that depend upon the salvage value and how many years you're going to use it. So at the bottom here, I have it's a 15 years for a tractor and 25% salvage value, et cetera. We look at a tractor, a combine, an implement. But here's the part I want to focus on. These are your annual costs you're going to be paying per $100,000 of expenditure. So if you buy $100,000 on a tractor, what is going to be the annual cost for depreciation and opportunity cost? Pick your interest rate on the left and run it across the side there. The point I want to make is, like, if you're in that, say, 5%, you're going to be spending $8,500, $8,900, $10,000 plus dollars on just depreciation and capital recovery, opportunity cost on that piece of equipment every year. And that's a hidden cost. You never see it. You don't write a check for paying the cost of depreciation or opportunity cost, but they're real costs. And the other thing I emphasize is these are on top of any of your operating costs, fuel and depreciation. Or this is depreciation and opportunity costs. It's not your operating costs for fuel and maintenance and things like that, or storage. These are just the capital recovery costs. And so what you'll see is it's a real cost. So just remind yourself to remind you always got that 8, 9, 10% annual cost for depreciation opportunity cost. Plus, you've got your annual maintenance costs. So think about those costs. The next one I want to think about is increasing your working capital. A lot of farmers have really used up their working capital. It's just your current assets minus your current liabilities. It's kind of a measure of cash on hand. It's liquid cash for unexpected costs or opportunities that might appear. Rainy day fund for your financial risk management. As you've used up working capital, it means you have to rely more and more on sort of a revolving line of credit, or however you pay for your costs, or to maintain your cash flow. If you can avoid using that revolving line of credit, you're going to save those interest costs. You're also going to spend less time managing your cash flow and finances, so you can focus on farming. You can focus on your cows, focus on your crop production. You can focus on your machinery instead of spending a bunch of time in the office trying to figure out how to get the cash to make your payments for this next month. The last thing is you can use that cash to take advantage of opportunities when they arise. If you've got working capital, when an opportunity appears, you can be Johnny on the spot with some cash to take advantage of it before somebody else does. A great price on a piece of equipment that you could really use, maybe a barn, a cow, a herd to buy some cattle, things like that. This is the working capital. This is from Federal Reserve Bank system, and they put this together on a regular basis. So you go way back over the years, and you can see the U.S. farm sector as a whole has really lost its working capital over the last while. And it's been flat here since 2016, 17, 18, 19, and 20. This is due to the low margins on most of our crops and livestock. And so the next thing, instead of working capital, is just pay off your deadweight debt. What they mean by deadweight debt is debt that did not or does not create returns above the interest rate, and it's creating a drag on your future profitability. You might have borrowed some money to buy a piece of equipment, and you're paying it off, and it's really not turning out to generating that return you expected. And so every time you're making money, you're taking part of it to pay off that debt. You're stuck paying interest when you can be moving forward on your equity. Well, here's your chance to pay it off and move on. Refinance and consolidate your operating loans or revolving lines of credit into lower interest rate long-term debt. That's been happening a lot. Well, here's your chance to just pay them off and not have to deal with refinancing costs and adding more to your mortgage, your land debt. Create some breathing room. So when you do have returns, like it looks like we have with this harvest time price rally we're seeing for like soybeans especially, creates that breathing room. And now when there is a profitability, you can really take opportunities of it, of that profitability, and use it to really get ahead on some of your other debts, your land debt. This is an example of what's been going on. I'm going to look here. This is way back to the 70s until 2020. The green line is your non-real estate debt, primarily things like operating loans and then machinery and buildings and stuff like that. And then the red line is real estate debt, which I'm interpreting primarily as land. And what you really see is back here in when the Great Recession hit. Remember that catastrophe? Um, where what you saw is the leveling off of this non-real estate debt. People stopped being able to do operating loans, increasing them, or buying machinery and things like that. Instead, they started rolling it over into this real estate debt. And that's what really took off. And that gap between these two has really spread. It used to be they followed each other tightly. Then starting about 2010, it really started to split apart. And that's the interest rates have been low on the real, and the people have been refinancing in essence and rolling more and more of their operating debts and other machinery debts and things like that into the land and away from these operating loans. So debt has really risen. This is back all the way back to the 1970s. See, we ran it up in the 80s, collapsed in a catastrophe of the 1980s, and it's been rising up. This is total debt, land and non-real estate debt. We're back up to where it was back in the 80s when we had that. The land it's overall is worth more as a percentage. It's not as high, but definitely the total amount of debt is in that $40 billion range. And it's also more concentrated in land than it was in the 1980s, if you go back and look at that previous slide. So overall, 2020 was a good production year here in the state of Wisconsin. We had high yields and there's promising price trends. There's a price rally here at harvest time with especially soybeans, but also corn, way better than we thought it was going to be when we were planning it. Lots of federal support is pouring into agriculture. We've got lots of acronyms: MFP, ARC, PLC, CFAP, CFAP2, PPP, PUA, and I forget the other ones. Many Wisconsin farmers are looking at a high income year. This is a broad national trend. Not every farmer and every commodity is looking that way, but there's definitely some positive looking things here on income. So what are you going to do with this extra money for those who have it? Obviously, managing taxes is a part of it, but I think it's time to be wise and make some good choices about what types of assets to buy, time to replace or assets that have been kind of wearing out, invest in new assets. This is a chance to maybe do robotic milking or something like that. But the key is to focus in on productive investments that increase your productivity or reduce your cost. You're going to be paying depreciation and opportunity costs that are real. You just don't see them. And you want to make sure you're aware of those when you make these investments so that you're making sure you're making wise investments. The other things to do is increase your working capital, give yourself a little more breathing room to get out from under your revolving line of credit that you've been buried under and wrapping up into your operating loans, wrapping them up into your land loan maybe. Chance to increase that so the next time there's a problem, you don't have to pay that interest rate and go through the cost of refinancing again. The other thing is just paying off dead weight debt. Debt you've been kind of hanging around your throat, pulling you down, keeping you from enjoying profitability when it happens. Get out from under some of that stuff and get ahead. All those are costs you can deduct in your taxes and can move you forward for long run profitability into 2021 and beyond. Thank you.